Good afternoon, everybody, and welcome to our November session of our SA Stock Pick series powered by the JSE. It really is awesome to have you join us again, and thank you for your ongoing support. This is our fifth and final installment for the year after kicking off the series in August. And today we'll be joined by four industry experts to help us go through the last session. And these experts have prepared a sharp and punchy session for you. So really excited to go through today's session. We really have been thrilled that you have joined the series to date and that you've enjoyed this series. And it really has been the JSE's honor to bring together industry experts to showcase some of our South African counters and the potential on our South African market. To date, over the first four sessions, we've had over 20,000 views across the first four sessions. So really has been a well-subscribed series. So thank you very much for your ongoing support. Today, as I mentioned, we are joined by four industry experts. We're joined by Preston Narayansamy, who is a portfolio manager at Nedbank Private Wealth. Welcome, Preston. We're joined by Abdul Davids, who is a portfolio manager at Kakiso Asset Manager. Lovely to see you and have you on our show, Abdul. Thank you for joining us. We are further joined by Dudu Tembo, who is a portfolio manager at Argon Asset Management. Lovely to have you, Dudu, and thank you for your time. And lastly, we will also be joined by Tatu Mashiko, who is portfolio manager at Sanlam Private Wealth. Welcome, Preston, Abdul, Dudu, and Tatu. Thank you very much for your time. So as always, I check if there are overlaps between the sessions. And today we will have 3 stock picks from each of our speakers, so 12 stock picks, and we only have 1 overlap. So you will be prepared to hear for 11 unique stock picks today. The brief is the same. We've asked each of the speakers to showcase their 3 stock picks, South African counters, 2 minutes of stock, and keeping things informative, sharp, and clear. So without further delay, let's get into it. As always, we will ask you to please stay engaged and feel free to post questions or comments in the chat, and we will field those questions as best we can at the end of the show. So we'd really like to get to know our speakers and we value their time. So we're going to kick off with Preston. Preston, thank you for coming onto our show today and joining us for this last session. Please, we'd love to get to know a little bit about you. So tell us a little bit about your working background, your company, as well as a fun fact about Preston, so our audience gets to know you a little bit better. And then after you've done your intro, please go straight into your 3 stock picks. Over to you, Preston.
Perfect. Afternoon, Valdine and everyone. It's good to be here. Just in terms of me, studied actuarial science, found it extremely boring, and then got into investments. So really enjoying it, very passionate about the markets. I'm currently with Nedbank Private Wealth, so I'm one of the portfolio managers. And how we look at money from a long-term perspective. And our motto is long-term and well considered. So we certainly have a valuation bias to the way we look at money. And we manage money, being cognizant of valuations. So one very interesting, fact about me, it's kind of a weird one, but I actually have a Doberman puppy who can do, weird tricks on command. Like he can whine on command, he can roll over on command, he can lick his lips on command. So that's probably the one weird fact about me. So maybe straight into my stock picks. All 3 of my stock picks, how can I say it? All 3 of my stock picks, quality companies, they steady compounders over time. They all, probably the best quality companies within their industries. And I'm actually ranking them from my best preference from a valuation perspective down to the least, but they're all solid companies. So they're the type of companies you buy them, put them in the bottom drawer, 3 to 5 years time, open up the drawer and it would have returned, a decent value for you. So the first one's actually Sanlam. So this is the largest listed life insurer on our market. Of course, they've got a traditional life insurance business and they've got a general insurance portion of the business via Santam. So of course, that's a profit driver for the business. And what's interesting about this company, I think it's the only company that's ventured into Africa properly. So they took a diversified approach into Africa, 30 odd countries, being exposed to that, not overly exposed to a specific segment. We've seen companies go into Africa and, really get their hands burnt. So it's a, it's a company that has a good track record, solid management team, good digitization initiatives happening, solid strategic partnerships by Capitec and the likes. And, this company at the peak of last year's sell-off, it was trading at around, 47 Rand. Currently, the company is trading at around 53 bucks. So I think they've held up well despite COVID and despite all of these pressures. Operationally, they're still sitting with a lot of cash, very prudent from a reserving perspective. And it's one of the dividend aristocrats, on our market. You can pick it up at a 5.5% dividend yield. So that's my number one pick. I think a lot of valuation upside on this one. My second one is actually Mr. Price. Okay, so as you know, it's a value fashion retailer. I think this company, is going to benefit from a high interest rate environment, and given, the fragility of the SA consumer, I think as people trade down, from the likes of Fushini and the other players that are in the higher LSM space, I think Mr. Price will be a proper beneficiary in that market. And, just looking at their numbers, from a market share perspective, they've solidly gained market share over the last year and a half. So certainly a good one. They've also, they've got the likes of, Power Fashion and Yappy Chef, recent acquisitions, which should serve the business well over the medium term. So a really good business from an online perspective, really gaining traction. Online sales making up about 3% of total sales. And, the Mr. Price apparel app, it's the best ranked app here in South Africa. So I think this company is positioned nicely, sitting with 4 odd billion on their balance sheet, a lot of cash, at a 14% PE and, a 4 to 5% dividend yield. I certainly think it's a good long-term play. Last stock, that's going to be right. I'm sure if you had a look at the results, solid set of numbers. It's the only, food retailer to report on their sales numbers without stripping out the effect of the riot. So this business, posted double-digit sales growth, including the riot. So my goodness, gaining a lot of market share, doing really well. I think they positioned really well, in the middle LSM space to defend market share there. And I think, in the higher LSM space, I think, they're really going to give Woolies a run for their money, in terms of their Checkers brand. So I think management as well here, they've been very, very, very prudent from a capital allocation perspective. So some nice work being done there. And I think at a 3% dividend yield and at a 16%, price to earnings ratio, it has had a good run, but I certainly think it's one of those companies, buy it, stick it into the bottom drawer, open up the drawer in 3 to 5 years time, and this company would have done well for you. So across the board, these are steady compounders. They're not going to give you, amazing returns, but they're steady compounders and they will generate long-term wealth for you. That's my stock picks, Valdian. Over to you.
Thanks, Preston. I think you can add your Doberman as one of your top picks. He sounds like he's got some tricks that are quite unique. So well done. So there you have it, guys. Sanlam, Shoprite, and Octodec from Preston. Thank you very much. Next up, we have Abdul. Abdul and I actually know each other for many, many decades. So it's lovely to connect again with Abdul. And Abdul, thank you very much for your time. And we'd love to hear a little bit about yourself, a fun fact or interesting thought, and then over to you on your stock picks. Thanks.
Thanks, Aldine, and good to be here and quite honored to be in this august company that we have here today. My background started out in markets in 1998, just before the big market crash in 98. Cut my teeth at one of the largest asset managers in South Africa. And I've been with Kagiso now for about 13 years. I also manage some of the Islamic funds, Kagiso Islamic funds with Kagiso as well. I don't have a vicious Doberman. I've got 2 budgies, so they don't do tricks. They just sit there and eat. But another fun fact, I'm also a keen cyclist. So yeah, I think in the asset management industry, you're either a cyclist or a golfer. So I think those are the prerequisites in this industry. Straight on to my stock picks. I'll start in terms of size, so from largest to smallest. I think the common DNA that runs across my stock picks is really our approach to long-term investing, which is to look at long-term drivers and sustainability of those drivers across companies and industries. And as we know, with COP26 having been recently concluded, we have seen a keen focus on the environment and sustainability. And I think that is a key driver potentially for many of our companies locally, but certainly a key emphasis globally as well. So with my first stock pick, one that I think your viewers and listeners should be familiar with, it has been featured before, Northam Platinum. The most recent M&A that we've seen today, I think today Impala has come out to make a counterbid for RB Platinum. But it just testifies to the philosophy of the Northern management, which is one of looking at creating value for shareholders. Over the last couple of months, we've seen them buy back Zambezi Platinum in terms of the preference share there and creating significant value for shareholders there as well. But taking a step back, I think if one looks at the platinum industry, South Africa has been endowed and blessed with abundant resources in PGMs. And really, the only real way to access those is through the JSE. If we look at our listed PGM miners, in terms of contribution to global mining output in PGMs, it's unparalleled. So the JSE is really fortunate to be blessed with an abundant resource base in terms of listed PGM miners. And certainly amongst the larger miners, Northam stands out. It's got the best portfolio in terms of growth. From current resource base of about 700,000 ounces, we see them growing over the next 5 to 6 years to about 1.2 million. And as we know with resources and mining companies, it's a simple price times volume equation. And with prices potentially being elevated, clearly you need to offset some of that price risk by growing your volume base and then also grow revenues. So certainly Northam stands out as being the best growth sort of portfolio. If I look at what they did over the last couple of years, 2016, they bought Eland, 175 million rand for that asset. At the peak, that was valued at about 10 billion rand. So clearly, in terms of management, Paul Dunn and his team, they've done excellent work in terms of creating shareholder value. Currently trading at less than 10 times P multiple, with the prospect of significant return of cash in terms of dividends to come as well. Second stock pick, another one that also plays into the whole electrification and hydrogen theme. So PGMs, clearly in terms of longer term, we see hydrogen being a key market for that, especially for platinum. And certainly, I think Omnia stands out. Omnia certainly has had a checkered past. Most recently, they had a big rights issue of about 2 billion rand. Stock price bottom out at sub 20 rand a share. But I think, again, Seelan and his team has done excellent work in terms of right-sizing the business, restructuring and pruning the portfolio. But really, the asset that stands out for us in Omnia is the Omnia Australia business. So if one looks at the three businesses in Omnia, you've got the BME, the mining business, which competes with the likes of Sasol in terms of supplying bulk explosives. And certainly they've gained market share given Sasol's travails and issues in the local market. The second business is the fertilizer business, which has been the heart of Omnia for many decades. But over the last couple of years, we've really been introduced to the Humates business. And that might be not a name that many of our viewers be familiar with, but similar to PGMs, Australia has been blessed with one of the most abundant resources of Humates in terms of the state of Victoria. And Omnia in particular has the lion's share of access to the Humates sort of resource base. And that, similar to your potassium and other NPK fertilizers, is really very useful in terms of producing, growing, fertilizing and areas under acreage. So we see the Humates business being as quite an attractive business in Omnia, substantially undervalued. Currently, Humates account for, I think, 16% of their profits. But we see value of up to half the market cap of Omnia in that Humates business. The last stock that I want to talk about, again playing into EVs and electrification, is a stock called Hulamin. Again, a much smaller stock and more for the punters out there. Only about 1.3 billion rand in terms of its market cap. But again, if one looks at Hulamin, I think it's the largest aluminium fabricator in Africa. They buy primary aluminium from South 32. And as we know, over the last couple of years, with the Eskom issues in South Africa, the big uncertainty around Hulamin was the future of the supply of South 32 aluminium. But the good news is in July, Eskom and South 32 have agreed on a 5-year agreement, and that is effectively thrown a lifeline to Hulamin. I note that the company is currently trading under cautionary. Unfortunately, one of those smaller caps that is potentially a takeout target, it's trading at half its book value. Substantial investment that has been made by Richard Jacob and his team in terms of right-sizing the business. You have the rolled products business, which supplies the likes of Nampak in terms of can volumes, but also the automotive sector. As we know, Tesla has been a customer of Hulamin in terms of supplying aluminium to the Tesla vehicles. And we see that theme again playing out in terms of the long term. As EVs become the norm, demand for aluminium will certainly pick up as well. As I said, trading at half book value, our normalized sort of earnings number, it's around a sub 5 PE multiple for Hulamin as well. That's it from my side, Valdine, and back to you.
Thank you very much. Very interesting. So Doberman and Budgie, we're getting to hear a little bit about people's personalities through the choices of pets they have. Abdul, thank you very much for the informative brief. Omnia, Northern Platinum, and Hulaman. Lots in the space and headlines at the moment in some of these counters. So definitely very topical. Thank you very much. Dudu, lovely to have you on our show, and thank you very much for your time. I'm sure just as much as I would like to get to know you, so would our audience. So over to you.
Thank you very much, Valdine. Thank you. It's great to have this opportunity to present the thoughts on some of our team's top picks. And also, as Abdul expressed, I also feel privileged to be on this platform with such an amazing group of fund managers. Yeah, so if I was really interested to hear Abdul's intro. I think we actually started out in the industry at a very similar time, and like Abdul, I've got my fair share of grey hairs. The interesting fact about me, though, is that I started my working career in engineering. I trained as a control engineer, and I remember one of the early projects that I worked on were designing a remote telemetry systems to be able to gather information and to control processes remotely. And I've been thinking of late that it's actually very interesting to what we do even now with our jobs as analysts, which is gathering information. Some of the data can seem quite disparate data, but we try to put it together, see if there are patterns, and try to use that information to optimize and deliver returns for our clients. Just in the context of today, I work for a company called Argon Asset Management. I've been here for about 6 years. I have worked for a couple of other asset managers, including Investec and what was then Gensec Asset Management. I really love what I do, and as a result, my team say that the words brevity and Dudu don't exist in the same sentence. So my work is cut out for me today to try to be as concise as I can. So I'll start out. My first share is high prop. I think what's common among the shares that I want to talk about today is that they've all presented opportunities because of recent price action, which was largely, I think, driven by the impact of the pandemic. As a house, we are firmly entrenched in the value universe. So obviously, when a share price comes under pressure, that automatically piques our interest. Just to paint the picture, I mean, South African REITs have been under a lot of pressure, especially during lockdown. The SAPI index fell 54% during the first quarter of last year, and high prop followed suit and actually fell to 74%. Some of that has recovered, but it still looks very, very attractive. It's a large liquid REIT, which offers global diversification. It has got significant geared operations in Africa and in Europe, but the core of the portfolio, about 60% of the NAV, is in what we see as best-in-class retail assets. And some of those include malls, which will probably be quite familiar to most of our audience today, which are Canal Walk, the Glen, and Hyde Park. These centers are very well located. They have flagship stores and they're very high in demand. Vacancies are low versus peers, and the malls are actually still attracting new tenants. On a relative basis, escalations are quite high, and foot count is recovering as well as our collections. We're seeing this pattern also coming through in the Eastern European portfolio, and to a certain extent, that recovery is actually ahead of that in the SA assets. Another factor that really interests us is the fact that management are executing on de-gearing the balance sheet. That's through a number of disposals in Africa and Europe, and we think that there's scope for that, for even further de-gearing. We do see some risks, however. I think probably the main ones being potentially deteriorating macro fundamentals and any further high-level lockdowns, because obviously that will impact on the retailers and that would have a knock-on impact on the retail REITs. And we are also concerned about the possibility of further NAV impairments, though we are hopeful that that risk has been mitigated somewhat. Another risk relates to the restructuring of their relationship with Heisted, which is a company that they have a 60% share in, which houses the Eastern European assets. So all in all, the share price, as I had mentioned, had declined in the first quarter of last year. It has rebounded somewhat, but the company is now trading at a 50% discount to NAV, which we consider to still be very attractively priced. Yeah, so that's essentially our thoughts on Hyprop. My next company is Prosus. Now, Naspers and Prosus are very well known in the SA investment universe, so I don't think I have to say very much about the business model and investment case there. And we recall also that the valuations of both of these are primarily, in fact, really very meaningfully driven by their investments and the exposure to Tencent. They do offer exposure to a portfolio of assets in the tech and internet and adjacent sectors. However, even though some of those assets are market leaders, unfortunately, they are not profitable. And the core business are still very much in the investment phase. Prosus and Naspers have made it onto my list because of valuation. And the preference for Prosus over Naspers reflects kind of their relative ranking. So Prosus offers a discounted entry into Tencent, and we believe that Tencent still has significant upside and growth potential. As most people know, China is in the midst of regulatory flux in the tech sector, and that has depressed valuations. So what we've seen is Tencent itself is trading at very attractive multiple, the forward PE of 24 times. And actually that falls to 15 if you strip out the investee portfolios. That seems quite heady if you look at kind of what are SA norms and what we would consider cheap. But you have to put into context that 24 comes from a peak rating of 42 times in 2014. And also that rating is at a significant discount to Western comparables. And the non-Tencent portfolio, when you look at valuation, seems to be largely ignored. It has a value of about $50 billion presently. Management think that could increase to 100 billion. We're not giving them full credit for that because we think that that's optimistic. The main risks we see are in the short term, which is volatility because of impact of Chinese regulation. We think that the reaction to that has been overdone by the market, and we actually have some sympathy for the motivation behind some of the regulation, especially around common prosperity. We are also concerned about the discount remaining stubbornly high. The recent share offer didn't actually mitigate the discount that this share is trading at, which management had thought would happen. But all told, it's trading at about a 50% discount to NAV. Prosus is also trading on a forward PE, which is about a 30% discount to its median forward PE. And therefore, we see it as one of the more attractive opportunities for investment in the universe. Then my last share is Quilter. Quilter is listed on the JSE, but it's a UK wealth management business. It now operates only in the UK, having disposed of its international business as well as its old heritage life business. And viewers may remember it as being part of the Old Mutual Wealth when Old Mutual was domiciled in the UK. And it was spun out when Old Mutual went through its managed separation process. It's a really, really interesting business to me because it operates across the full wealth management value chain. And to my knowledge, it's the only UK listed wealth manager that offers that opportunity. It has a dual distribution strategy. So it acquires clients through independent IFAs as well as its own agents who are referred to as restricted financial planners. It has two main businesses, affluent and high net worth client business. And the high net worth client business is very interesting because it actually traces its history back to 1771. And then the other thing which I think is very important, Quilter launched an investment platform which allows it to offer a much broader range of products. Again, I like Quilter because it offers diversification. When you look at the local listed financial shares, it also offers currency and geographical diversification. It's trading on a forward PE ratio of 17.5 times. Again, looks heady relative to SA, but when you look at global peers and UK peers, it's still trading at a substantial discount, in some instances up to 30% discount to UK peers. The forward divvy is 5%, and I think that's going to be enhanced by a special divvy, which will be funded from the proceeds of the latest disposal. And that's why I particularly like Quilter, and I think it's well worth considering as a long-term investment. Thank you.
Excellent. Thanks, Dudu. So there you go. You've managed to keep on time. So well done to you. And thank you for the deep and wonderful insights coming from that breadth of experience that you have. So Dudu's picks are Quilter, Process, and High Prop. And really some interesting rationale and investment thesis behind that. So thank you very much, Dudu. Last but not least, the man who's definitely dressed the part for Monday. I mean, I worked with a counterpart, and if he's watching, I'm sure he'll smile. But he always dressed up in a three-piece suit, and he said, dress the part that you want to have and not the part you're in. So Tatu's dressed, I think, up for the Oscars. I love the bow tie, definitely adding some charm to today's show. Tatu, thank you for joining us, and lovely to have you on our show. We'd love to get to know a little bit about you. So love to hear your history, about your career, as well as a fun or interesting fact. So over to you.
Thank you, Valdine, for that very generous introduction. And I'm glad to hear that the bow tie is not too out of place in a financial or investment setting. So that's very good to hear. In terms of myself, well, I think I've had a shorter career than my other esteemed panelists. I began my journey during the GFC, or the Great Financial Crisis, but since then I've managed to have a few varied experiences. I've worked as a casino dealer in the US, I've worked as an English teacher in China, and I've also worked in film production outside of suppose banking and investments. So it's like my generation of millennials, we do tend to move and experience different things. So I don't know if that's a fun fact or not, but other than that, I enjoy cooking and jazz music and bow ties, clearly. So I suppose with having said that, let me put my timer on just so that I stay within the expected realm. My three stock picks, I think, cover somewhat different types of investment cases, from one which may be somewhat valuation driven to another which may be more turnaround or perhaps potential catalyst driven, and lastly to one which is more thematic / momentum driven. So the first one, which I share with Dudu, would be Process. And a lot of people would not be happy to hear that Process may be considered a valuation-driven investment case at this point in time. But be that as it may, where we are with Process, and obviously you have to begin with Tencent, which is where the bulk of the value from Process lies. Common prosperity, obviously, with the regulatory risk that came with it, has resulted in Process falling around 17% year to date relative to 15% positive return from the local market. And people view the uncertainty with valid concern. However, if you consider what Common Prosperity is trying to achieve from an economic perspective, it's a growth in disposable income and in the size of the Chinese middle class, which ultimately is beneficial for Chinese enterprises. And the government in China, whilst they are obviously increasing regulation and scrutiny of their major companies, they are not trying to throttle these companies in any great extent. So what exactly has happened with Tencent? Well, what we've seen with their most recent results from Q3 2021 is that common prosperity has not had a materially undue impact, or rather the change in regulations. For example, within gaming, we know that under 18s or minors were limited to 1 hour per day from a gaming perspective, and they have now fallen from a minutes of usage perspective on Tencent's platforms to 1% versus 6% in the past year. However, we've still seen an uptick in gaming revenue, both from a domestic and an international perspective. And Tencent has now disclosed international gaming for the first time because they've made a lot of investments in IP and in producing games for the global markets. So games such as Clash of Clans, for example, and that division growing 20% year on year, showing that they are able to actually gain users and customers, not just within the mainland, but in the broader context of the global economy. Also, from a fintech perspective, in Tencent's latest results, we see that fintech is now a third of overall revenue, and the fintech business is still growing at north of 30% year on year. This has historically been driven by consumer payments within TenPay, but we're now seeing businesses being uploaded or onboarded onto the TenPay platform and doing their B2C payments through TenPay, and this is also boosting usage and further entrenching the ecosystem. And obviously, fintech is a lot more annuity-based income relative to gaming and online advertising. So this is beneficial for Tencent overall. From a process perspective, my previous speaker did mention some of the highlights around process, with their view, or they're wanting their NAV to grow to over 100 billion over time. What's interesting, I think, is if you consider they have been selling down their Tencent stake to fund some of these new investments. And if you look at the last stake they sold a few years ago, management says it has generated a 30% IRR. So it is not the case that they're just selling off a great asset and reinvesting it poorly. They are generating strong returns from the new portfolio of assets across e-commerce, fintech, edtech, and food delivery and other places. They have some dominant platforms like OLX and iFood and Delivery Hero in the food space, as well as the edtech space like BullDesk, Udemy, and in the fintech spaces, the new BullDesk acquisition creates the 7th largest payments company globally. So it's very positive from the Tencent and the process perspective. From a valuation perspective, north of 40% holding company discount from a process perspective. Tencent at historically low forward PEs relative to its history of 30 to 40 times, currently at 24 times. You're getting the entire listed portfolio for free, which includes great assets like Sea, JD, Bilibili, Kuaishou, and so on and so forth. So really the valuation not really compensating for Tencent, which is one of the greatest VCs in the world, given their track record and the companies that they have invested in. Also, the unduly high holding company discount from a process perspective, especially given the strong IRRs that they are now generating and revenue growth from their underlying investee companies. So Tencent, dare I say it, a value stock at the current moment in time. Moving on to MultiChoice. Now, MultiChoice has underperformed the market since it's listed, and that's because the SA business is largely ex-growth, and we've had significant losses in Africa due to currency devaluations. However, where we are at the moment, Africa constitutes around 35% of revenue, but is negligible from an EBIT perspective. Management expects Africa to break even in 2023, and once that happens, obviously there is a significant EBIT uplift from losses to positive territory. From a pay TV perspective, there's massive underutilization in Africa as a whole. SA in Latin America has comparisons at 40% penetration rates, whereas Africa, markets like Nigeria and Kenya, sitting at only 50% penetration rates. Some of the losses in subscription that we've seen in South Africa from a premium perspective have been made up on the Showmax side from an OTT perspective, and also in Africa we're now seeing positive subscription growth, whereas historically over the past 4 years we've had negative subscription growth. Added to this, Vivendi, the global media company, has a 15% stake in MultiChoice. This is a free call option on a future potential takeout. We know that MultiChoice multi-choice trades at a relative PE multiple significantly lower than global peers at around 15 times versus north of 20 times. The balance sheet is also ungeared. And so as we see Africa turn into positive territory from an EBIT perspective and a positive subscription growth perspective, that takeout premium will increase, as well as some multiple uplift from a multi-choice perspective. Last but not least, Glencore, and with a major caveat from an ESG perspective, we know that there are significant social and governance concerns with Glencore. However, I think the best way to engage in ESG concerns is through advocacy and engagement with management. So we know that multiple jurisdictions are currently pursuing lawsuits against Glencore for their activities in DRC and through their trading business with oil in Nigeria and Venezuela. And this obviously has a downward impact on sentiment for the company. However, if we consider where spot prices are for their commodity basket, and obviously spot prices can't be extrapolated into perpetuity, but over the short term, given global supply chain bottlenecks and their commodity basket is largely directed towards base metals, things like copper, zinc, lead, and nickel, I think that in the short term, at least over the next year, spot prices are not going to decline significantly, which would lead to free cash flow generation north of $11 billion. The largest fine ever for a corruption case from the Department of Justice is $4 billion, which suggests that Glencore would comfortably be able to pay whatever contingent liabilities may arise from the US corruption scandals. From a thematic perspective, renewable energy with COP26 is obviously huge on the agenda. Glencore, through their DRC cobalt operations, control 50% of global cobalt. And cobalt is a key material which goes into lithium-ion batteries, which obviously is a major component within the EV space. And major regions like China, Europe, and others have put in set emission standards and targets for EV penetration over the next 10 to 15 years. And Glencore will be able to play along that theme, along with those regions as electric vehicles become a lot more prominent. The balance sheet is also quite ungeared. They've been paying down debt. There's very minimal capex. They've been very good from a working capital perspective, and this has led to an uptick in free cash flow generation and the potential for further dividends. And we think, or at least I think, that Glencore will be able to harvest larger payouts and larger dividends going forward from the current position. So all in all, there are serious governance concerns, but cash flow should be able to cover whatever fines materialize from that. You have the long-term thematic theme of EV through the cobalt operations. You have strong dividend potential being paid out if spot prices do maintain over the short term. Inflation is not transitory, and so that should in fact occur. And you also have them selling off small assets in their portfolio which are non-core. So all in all, Glencore from a thematic and a momentum perspective looks promising as well. So that is my all my three stock picks, somewhat varied investment cases, but all interesting in different ways, I think. Thank you, Valdine.
Thank you, Tatu. So just as a recap, as I mentioned earlier, we have 11 unique stock picks. Tatu had a process as well, which Dudu had, and then as well as Glencore and MultiChoice. But to recap, Preston had Sanlam, Shoprite, and Mr. Price. Abdul, Omnia, Northam, and Hulaman. Dudu, Quilter, Process, and Hyprop. And Tatu, Process, MultiChoice, and Glencore. Thank you very much to our speakers, and really has been insightful opinions and comments. We really do appreciate your time and your insightful assessment. As a disclaimer, the views and opinions expressed represent the personal views of our speakers, and the JSE sponsorship and facilitation of the session is not an endorsement of the views expressed, nor does it constitute advice by the speakers or the JSE. Really, the objective of this show is just to create more awareness in our South African markets and to promote financial inclusion, which is a huge priority. And in doing so, growing shared prosperity is a joint ambition. So we really do trust that today's showcase gives you good insights for consideration. As mentioned, we would tackle questions, but we don't have any questions that we have online. So a really appreciative audience. However, lots of comments around likes and value in the show. So thank you very much to our speakers for your time and to our audience for dialing in. As has been asked, our next session will be in February next year. We have penciled in a date in the 3rd week of February, but as we finalize that, we will send out social media alerts. For now, that brings us to the end of this show. We really appreciate your time, and we want to wish you on behalf of the JSE all a festive and a joyous and safe festive period. Really hope you get in some good rest and relaxation. And until Feb, we hope you have a good afternoon, and we will chat in the new year. Afternoon all.